Hi, my name is Austin King. I'm an economics major here at PC. I worked for a hedge fund this summer with Russell Jeffrey at Providence Investment Management, where I became good with Bloomberg and other things such as Yield Book. I learned about the overall market and did a lot of macro analysis. I also now am employed with Orenda Financial, where I did working strictly with fixed incomes. I think it broadens my horizons and my knowledge, and also my economics background has allowed me to work with data and produce a lot of different regressions that can be helpful to the team.
I'm Andrew Pasolka. I'm a senior finance major, accounting minor. This summer I was interning at Liberty Mutual, working in the commercial insurance policy and controls department. There I learned a lot about reviewing and analyzing financial statements.
I'm Kyle Dillaway. This past summer I worked at HSBC on the trading floor, and we worked a lot on valuations and modeling, and I think I could bring that and hard work to the team.
So here with Coach, we believe that Coach is a sell because Coach is going out of style. And Kyle?
The current market price at Coach is $29.44. We calculated on one of our valuations that the intrinsic value is $19.26 a share, so we think there's a bit of room to go down, which is why we're recommending to sell, because if you don't sell, you could lose up to 34.58% of your equity in the company.
So our first valuation that we put together was the enterprise value over EBITDA. We decided to use this valuation model because it takes into account debts and things such as cash equivalents that PE doesn't, so we think it's more applicable. And so that's how we reached our first intrinsic value of 19.26.
So for our WACC calculation, we got 12.23%. To calculate this, we used cost of equity and used the 10-year S&P average. So what that tells us is there's a high discount rate, which means the future cash flows will be it'll be hard to gain future cash flows, and that also tells us that it makes it harder for the company to gain financing and add to their capital structure. So the competitors that we saw were Hermes, Kate Spade, Michael Kors, and Louis Vuitton. If you look at our PE, EPS, PS, PB, and beta, you see that we're below our competitors on almost all those fronts, and we're below the market average. Also, it's important to note that our beta is below 1, which will make us less volatile. Looking again here, you see our return on assets. We're kind of right in the middle of the field, so they're decent there, but not really a strong case there. Also, with return on equity, you can see that we're below all our competitors. They're not getting good enough return from their investments compared to the rest of our competition.
We decided to include a quick graph on total return. It might be tough to see in the video, but this red line here for total return is the peers of Coach, and then this blue line down here at the bottom is Coach itself, and you can see that there's a dramatic difference in the total return between the peers that were chosen by Coach and the Coach actual total return. So I think it's notable that how poorly it's doing in the market over history. And then we also put together a quick DuPont analysis. DuPont analysis is broken down into 3 parts: the operating efficiency, the asset efficiency, and the financial leverage. We try to target where Coach is actually struggling, and we noticed that their operating efficiency and their asset efficiency is actually continuing to decline since 2011. So there's a significant drop here. Oh, can you go back quick? There's a significant drop from 2011 to 2014. Their financial leverage has actually improved, so that's one notable point, but their total asset efficiency has continued to decline drastically as well. We think those are all key points.
Some operating inefficiencies we've noticed with the company is their employees don't make as much as per sale for our company as other competitors do. So this affects our profit margin, as we need more employees to make up the same number of sales as our competitors. And you can see as our profit margin is the second to lowest on the bottom, those excess employees who aren't providing enough value for us are hurting our bottom line and affecting our stock price.
So we try to target a few areas of risk. We use the Porter's 5 forces of competition. They're scaled 1, 2, 3, 4, and 5. 5, the outermost ring being the most risky, and we noticed that the biggest threats to Coach were from substitute products such as knockoffs that can easily be sold at a discount, and competition in the industry because our competitors seem to be having a competitive advantage over us in several areas. We also looked at some major risk factors such as a major economic downturn, slowed down growth, and Coach operates a lot in international markets, which a stronger dollar is playing a major role. Even though it may wash out eventually, it's hurting them in the near term. And they have a multi-year transformational initiative, which is not really taking hold the way they hope to give a new face to the brand, and we think that's a major risk for them.
Some comparables. The current price, as we had mentioned before, is $29.44 a share. It's been on a downtrend since we said earlier in January 2014, and we see it continuing down. We did two different models. One is enterprise value divided by EBITDA. We calculated that to be $19.26 a share, and our discount dividend model indicated that the intrinsic value of the company is $13.50 a share, which indicates we think that we have a lot more, room to run downward. Our last one, we did a 70-30 weight comparison from the first valuation to the second one. We think that better represents what we're doing because it includes some of the debt and other things that are a part of our company's financial statements. Rise of the dollar, we talked about this before. The European companies Hermes and Louis Vuitton have appreciated in stock price over the last 52 weeks, mainly because of a stronger dollar. Their sales in the United States allows them to earn a higher return when they bring the money back into their country because of the rate of return. American companies have all struggled in the last 52 weeks because their sales have been affected because of the strong dollar. Coach has lost 20% in the last 52 weeks. This is mainly because of the strong dollar. So whenever we bring the money back in from Europe or China, where Austin said earlier about 40% of our sales are located, it comes at a discount to our previous revenue.
So we put together a quick sales growth forecast. Our sales have been down for the last 3 years and down 13% from 2014. And since it's a luxury item and there may be a recession coming, and we think that the luxury items will be the first to go, things such as this hurt the sales, and they've also reduced the number of retail stores by 22% from last year. So we expect to see a decline again in the upcoming year of 7 to 8% roughly.
So based on a recent decline in dividends, we forecasted that the dividends will decrease by 3% on an annual basis. We found this using a two-stage Gordon growth model and forecasted growth at 2.4%, which gave us the intrinsic value there of $13.50.
In summary, we decided to sell Coach for a number of reasons. Coach stopped increasing the dividend. The dividend had grown at a 7.5-cent clip a year until 2013, where it stopped and remained at its current dividend price. As the stock is depreciating, it's providing a lower return to shareholders. The strong dollar has hurt foreign sales. Coach's brand has lost a bit of its appeal. It's no longer thought of as highly as it once was, and Hermes and Louis Vuitton has been eating away at its business. Since Victor Luis and his management team has taken over in 2014, the stock has fallen from $55 to $29.44. This has shown an inability on the management's part to get meaningful returns to shareholders, and then in terms of investments and building its business. There are currently too many outstanding shares, which is hurting the earnings per share of the company, and as a result, it's affecting the return on assets, which is one of the main things that investors look to when they're trying to invest in a company. Excessive costs, such as too many employees, has weighed down profit margins. We're also have the smallest profit margin in the industry as a result of our inability to produce our products cheaply. Employees are not as efficient as their industry rivals. As such, we have more employees to get the same number of revenue as rival companies. And as I said earlier, we have an inability to get meaningful returns on our investment in comparison to both our international and American competition. And the main reason we think that you should sell Coach is because their employees and their management team are as well. If they don't want to be a part of this stock, neither should you.